How's it going, traders? I hope you're all doing well. I hope you're safe. I hope you're healthy. I hope you have a smile on your face. And I hope you're catching pips as usual. Pips of Persia here with another quick video breakdown on NZDUSD and NZDCAD. I feel like every time I say quick video breakdown, it ends up being half an hour long anyway. But as promised, let's jump straight into kind of breaking down these two currency pairs that we ended up taking the trades for. So let's start off with NZDUSD. The analysis behind this trade was actually kind of very straightforward and simple, and it resulted into a total of a 1 to 22 risk reward position, the final positions, the final take profits being hit as well. So what I'm going to do is I'm just going to put it in replay mode and start analyzing from around the points that we started to see the market at. So let me get rid of that risk reward and jump straight into it. So this analysis was practically majorly just based on the 15-minute time frame. It was this 15-minute structure that helped us to kind of understand and to know that this market is likely to potentially create higher points. Now, some of you may be wondering how comes this is, a consolidating market. This is a market that's, going sideways. So why did we put ourselves in the position to look to buy this? The answer to that is your simple Wyckoff accumulation, right? Within the Wyckoff accumulation, the general structure will look like, similar to something like this, okay? Where you'll have your seller's climax, automatic rally, secondary test, some sort of sign of strength, and with your secondary test in phase B, and your final spring, which is a manipulation of all the lows before this market kind of goes any higher. So applying that understanding of the Wyckoff accumulation to what we can see on the charts right now, then we can go ahead and pinpoint and identify all of the key levels that we should be looking at for the for Wyckoff accumulation, right? That can be my bias climax over there, with the automatic rally, secondary test, and quote-unquote sign of strength. Following this, we got our secondary test in phase B, and the final push to the downside was our spring. So in terms of the Wyckoff schematic or Wyckoff points for an accumulation, it's perfect, right? What we see in front of us is amazing. It's a very kind of textbook schematic for accumulation. Now, the step after an accumulation, or what makes an accumulation or a distribution valid, is a break of structure in the desired direction, right? What makes accumulation or distribution valid is a break of structure in the desired direction. So that's extremely, extremely crucial and important. So make sure to write that down somewhere. What makes accumulation or distribution valid is a break of structure in the desired direction. Now, when it comes to accumulation and distribution and that break of structure element of it, majority of the times, a lot of the times, we don't have to wait for a big structure point to be broken for us to be able to then take our trades based on that. What some traders might do is you will identify, for example, this 15-minute distribution, and you would want to wait for the 15-minute break of structure. As valid as this could be, right? You can get a move something similar to this. You'll get a break of structure and a pullback before the continuation to the upside. We don't necessarily have to wait for 15-minute break of structure. We could be looking for lower time frame break of structure, right? In this specific case, I don't actually need to go any lower than the 15-minute time frame for the entries or even for break of structure, because we were able to see very clearly over here that was my final break of structure, or not final break of structure, my main break of structure. That's when the market started to shift in momentum. That's where the market created a low, a high, higher low, and a higher high. So we've even got that typical 1, 2, 3 wave that we have created as well, right? So this is now, making that accumulation valid. We have broken that first bit of structure to the upside. Therefore, this whole accumulation cycle could very well be a valid accumulation cycle, right? The step after this is very simple. You identify your structure points, as we mentioned. Low, let me do this in a different color. High, higher low, and higher high. Now, If this is a buy position that I want to take to the upside because of the accumulation and because of break of structure to the upside, then this specific trend, this smaller scale trend, needs to maintain. If this starts to come down here and break below these points, it's going to make me second guess these trades. It could still come down, wipe the lows again and go higher. I know that. But naturally, if this is the trade opportunity that I would want to take, I would naturally want to see the market stay above the last key point of structure within this smaller scale trend, right? Which will be that point. The final higher low. Let me put a little border next to this to make it a little bit easier to see, right? That final higher low that we have created over there. Low, high, higher low, higher high. That higher low should not be broken if we are looking to take our trades to the upside, right? Now, this then tells me where I should potentially be looking for entries, which will be above this level. Straight above this level, what do we have? An institutional candle, a sell before you buy, followed by an imbalance. Where am I looking at? I'll leave that final structure point in actually. This is my final sell before you buy candle, and the imbalance that it left open after is here, right? That's your imbalance over there. So a lot of you who are trading smart money concepts and Wyckoff, then you're able to now see this, how this one candle is a lot more valid to take entries based on, because we have left imbalance open after, and because that's our final push to the downside, the final sell before you buy. So the entries for this specific trade would have been at the wick of that candle. Now, there are good reasons why the entry would be at the wick rather than the body of the candle. But the best way I can describe that is, let me put it this way. Okay, this video is going to be a little bit longer than expected, but here's the example that I can give, right? Let me draw it out. Let's say we are looking on the 2-minute time frame, and let's say on the 1-minute time frame, for example, right? And on the 1-minute time frame, you can see a candle that's pushing up. That's the 1-minute candle, the candle that has pushed up, and a candle that has pushed right back down. Okay? So if you see these two candlesticks on the 1-minute time frame, it's a no-brainer that, if you go to the 2-minute time frame, majority of the times, yeah, you will be seeing this candlestick, right? If you look at a higher time frame, where is it? Bring to front, that's it. So if I look at these two candles on the 1-minute time frame, I'm gonna write down here 1 minute. Should have typed it instead of write it, but anyway, if those two candles are giving you a bullish candle followed by bearish candle on the 1-minute time frame, these two candles added up together form this on the 2-minute time frame. The open price was where? Over there, right? That was where where this candle started to form before it dropped, right? So that's our open price. That's the highest level that we reached. And that's our close price down there. With this mentality, if you see an institutional candle like this with a wick to the upside, right? Then you know that chances are on another time frame there was a full body candle pushing to the downside completely. Meaning what? Our entries doesn't have to be at the open price of that institutional candle anymore. The entries could be at the wick, because that's where the major sell before you buy action took place, right? So when we look at this structure over here, that will be our entries over there at the high of that wick. Simple as that. So our trade setup would look like this. Entry over there, stops at the low. And now in terms of our take profits, if this is an accumulation cycle, let me quickly get rid of these. If this is a valid accumulation cycle, then I know that we are going to at least see a lot higher prices. We're going to be visiting at least some regions within here. This has to retrace, in my opinion, at least about 76%, right? So this was when I went up to the daily time frame actually to have our final profit points based on the daily highs, right? So let me extend this. So at this daily high over here, at the high of this wick, this trade would have given us a 1 to 22 there and then. So that was when these final positions were finalized. Now, do I think that this market is gonna go a little bit higher? Yes, it can. There's potential that we've even got a gap up here on the daily time frame. So yes, 100% it can push higher, which means the risk reward would have been much better as well if we kept it open. But that's not the point. The point is that's still, you know, a valid trade that we have taken, and if this is likely to push higher, it will later on give us a much better, well, maybe not much better, but it will give us definitely more entry opportunities, right? So based on the accumulation over there on the 15-minute time frame, we entered, well, with the breaker structure. Let me just bring this side a little bit. I'll make it more accurate when I zoom in. And then the final take profits were up here. So let's put those final TPs in. Let's go back to 15-minute. Right there. So that's where that 1 to 22 risk reward came in. The rest of this was just having the patience for this market to come to the entry point and, well, give us our entry really so we can execute the trade. So that was the initial entry point over there. The market came, rejected the wick of this candle. They even rejected the open price of the body as well, to be honest with you. So we would have been able to get better risk rewards over there. And yeah, this market started to completely take off. Even monitoring this trade on lower time frame, when it was approaching that level as well. Some of you may be wondering, oh, we came into that level extremely impulsively, so how comes we still decided to take the trade based on that? The thing is, this is not necessarily an impulsive move as such, especially when monitoring that on the 1 minute time frame as well. This market is definitely pulling back, slowing down at that level, so it is giving us the opportunity to be able to kind of enter this as well, right? The rest of this was just having the patience until this plays out. Let me go on a higher time frame so it happens a little bit quicker. Oops. Well, I didn't mean to do that, but same point, right? That ended up making its way all the way up for a 1 to 22. That final TP was hit, right? So that's it. That's all the positions closed based on an accumulation and break of structure, found the institutional candle and executed. As simple as that, right? The other trade scenario that we had was NZDCAD. Now, NZDCAD did go a total of what is this risk reward? Can't even see it clearly anymore. This trade went a 1 to 19, I believe. I believe it was just short of a 1 to 20. Oh no, it did. It did give us a 1 to 20 in the end, almost. So this trade has gone a 1 to 20 already. Currently, and by currently I mean right now, 2nd of July, Thursday at 3:37 p.m. UK time, is floating at 1 to 13. Currently, the final TPs are up here for now. But this might be a trade that we might just have to close and take our profits from now. But let's kind of break this down together. This one is a little bit more in depth, a little bit more, how do you say it, maybe more advanced in terms of kind of the Wyckoff schematics. It was based on a re-accumulation cycle. And that re-accumulation cycle is, let me put this here. That re-accumulation cycle was followed by break of structure in the desired direction and entries based on imbalance and institutional candles, right? So let's start to break this down. I believe hourly, yes. On the hourly time frame, this general schematic that was formed it could have been mistaken with a distribution schematic, right? Because you would be looking at this. Let me remove all of these first. You might be looking at this general kind of structure or consolidation or whatever you want to call it, or divergence, and then you might be thinking to yourself, hang on a second, this looks like a perfect distribution, right? Let me put this replay mode. There we go. This looks like a perfect distribution, and you may not be wrong. That is completely correct. But the reason why we considered this an accumulation rather than a distribution is some of the characteristics that this started to develop within the second half of that schematic right over there. Some of the characteristics that it started to develop. The first thing was we created a lot of liquidity below this level. A lot of retail traders would be looking to buy this to the upside somewhere within this level, maybe not even remembering that the markets are going to be closing over the weekend, entering this, and as soon as the market opens, they're wiped out, they're gone. So this move to the downside, you can consider that a sign of weakness, but more than anything else, to me, that was just a shakeout over there. That was an area that all of the retail traders got shaken out of the market, right? a complete shakeout of the market. So if I want to start to mark this up, that will be my buyer's climax up there. You can consider that a buyer's climax, automatic reaction, secondary test, and your potential sign of weakness, or let's say a shakeout. Then what took place after this is we started to make our way to the upside and create a new automatic reaction. Another potential secondary test over here, but this up here was our sign of strength. This general structure was basically just a manipulation of the lows and a break of structure to the upside. Okay, what we always talk about when it comes to a market that's accumulating to go higher, is that you will get a manipulation of the lows and a break of structure to the upside. Again, a manipulation of the lows and a break of structure to the upside. So that was very clear that we are within that re-accumulation phase. Now, there's a lot of different schematics that can occur when it comes to a re-accumulation. This specific one, actually, I'll leave this one for now. Within this specific trade, we just waited for this creek. Oops, go back to the hourly. This was our final creek to be formed, whether you want to call it a flag, a creek, whatever it is. But this is our final, let's say, confirmation that this market is now indeed likely to start to go higher. Especially why? Because we started to break structure to the upside. Wherever you want to identify your structure point, we did break it to the upside, right? We have broken structure to the upside. So now I have the general hourly structure that I will be potentially looking for buy positions rather than sell positions in that case, right? Then it would be points of take profit. So you can see the 4-hour high over there, but that was based on the daily time frame as well. So since we were re-accumulating at a previous reversal zone, my personal take profits would have been at the next daily high, which is right over there. Practically 0.88888. 0.88888. Okay. That would be where we would want to be taking our profits, right? Now, the rest of this analysis was finalized on the 5-minute time frame for us to then be able to see, okay, which areas have we broken to the upside? What should we wait for in terms of breaker structure to the upside? And where should or could we potentially be taking these trades, again, to the upside, right? So where is this? First things first, pause. This market started to push higher and higher and higher and challenging all of the highs that this market started to form, which was a good sign for us who want to be looking to buy this to the upside, right? So we had a little bit more patience. We waited a little bit more for this market to give us something a little bit more clear that we can potentially kind of go based on. And it's taking some time. There we go. This was the point that we started to now fully break that structure properly to the upside. So we have now broken that final bit of structure to the upside as well. We have officially properly came out of that creek, right? Following that, it would be waiting for the market to give you potential entry points for you to then be able to enter the trades based on that, right? Now, I'm going to play a little bit more just so it comes to our entry. There it is. So this was where we initially saw the trade. Let me put it back in replay mode, right over here. So this is where we initially saw the trade. After all of these highs were properly broken to the upside, the rest of it was just waiting for this to pull back to fill in the final imbalance or to mitigate the final institutional candle, and then we would have taken our trades based on that. If I'm not mistaken, that was 2-minute institutional candle as well. There is. Right over there. Okay? So let's go back to the 5 minutes. You can see that based on the 2-minute time frame, that's your final sell before you buy candle. That's your final push to the downside. The market doesn't need to come anywhere below this candle anymore. That is the candle that's holding things up. So it can come back, mitigate the positions, and continue going higher. On top of that, it left imbalance straight after as well. And some of you may say, oh, you know what? That imbalance was filled as well. True. But when we look at the time frame that gives us that institutional candle, that imbalance is still valid. This still can come down to fill this imbalance, right? So let's go 3-minute. Continue playing this. There is. So where would our entries have been? Entry. stops, the low of that candle, are the 3 pip stop loss, and the final TPs, which are all the way up here, giving it that final, give or take, 1 to 24 risk to reward ratio, right? Now, again, once you've executed your trades, once you're in your positions, the only thing you have to do after is manage your trades and be patient, okay? Be patient and just manage your trades. Let it play out, okay? Don't want to keep jumping into new positions. Just let the market do its thing. Let me go on a higher time frame so again it happens a little bit quicker. And there we are right now, okay? So this was a trade that in total, as I mentioned, did indeed go a 1 to 20. Okay, it has given us that 1 to 20. But in terms of whether I will be keeping it open all the way to the final take profit or not, it really does depend on how we start to progress over here. I want to kind of see whether that was a proper break of structure to the downside over there. If we start to break a little bit lower, then I'll just close the rest of the positions at whatever risk reward we manage to get. Even as of right now, where the market is sitting, a 1 to 14 or a 1 to 15 as it is right now, is still fantastic risk reward ratio where we can close our positions there. But these were the 2 trade scenarios for NZDCAD and NZDUSD. Very kind of simple analysis in the sense that everything was just based on the Wyckoff schematics, right? Once you understand these schematics, then you can easily be taking kind of your trades based on these schematics alone, really, and based on the smart money concepts that follow these schematics as well. But the rest of it is just having that chart time more than anything else, having hours and hours and hours that you are looking at different charts, or you're spending your time on Go Live, watching live videos, you know, hanging out with more traders who have been doing these concepts, who have been trading these concepts for longer than you have, for you to then be able to get the grasp of these concepts properly. But I hope this video was helpful. Feel free to let me know if you have any questions, if there's anything else that that you might have learned from this video. Feel free to reach out to me on my Instagram. And with that being said, have a great weekend. The weekend is ahead of us now, and make sure to start to master these concepts and start to implement them. Backtesting is key. Let's elevate, family, and let me know if there's anything else that I can help you out with. Let's go.